In 1997, entire economies collapsed in a matter of months. Currencies lost half their value. Stock markets crashed. Millions of people fell into poverty almost overnight. It began in Thailand, but it didn't stay there. Within a year, the crisis had spread across Asia to Indonesia, South Korea, Malaysia, and beyond. This is the story of the Asian financial crisis. During the early 1990s, Asia was unstoppable. Countries like Thailand, South Korea, Indonesia, and Malaysia were called the Asian tigers. Growth rates were explosive. Foreign investors poured in billions of dollars. New skyscrapers filled city skylines. Stock markets soared. Currencies were stable. Confidence was everywhere. It looked like a miracle. But underneath the rapid growth, something fragile was forming. Most Asian economies had pegged their currencies to the US dollar. Thailand's currency, the baht, was tightly linked to the dollar. This created stability. It reassured foreign investors, and it encouraged massive borrowing. But here was the problem. Companies and banks borrowed heavily in US dollars, not in their own local currency. Why? Because dollar loans were cheaper. Interest rates were lower, and everyone believed the exchange rate would remain stable forever. That belief would soon collapse. Thailand was ground zero. By 1996, cracks began to appear. The country had built too much. Real estate projects were everywhere. Luxury condos stood empty. Office buildings had no tenants, but construction kept going. Banks had lent aggressively. Foreign debt had grown enormous, and investors began asking questions. Was the Thai economy really as strong as it looked? Speculators began betting against the Thai baht. They believed Thailand did not have enough foreign reserves to defend its currency. At first, the Thai government denied everything. They insisted the economy was strong. They used billions of dollars in reserves trying to defend the baht. But markets are ruthless. On July 2, 1997, Thailand gave up. The government allowed the baht to float. Within days, it collapsed. Its value fell dramatically, and panic began. When the baht fell, everything changed. Remember those companies that borrowed in US dollars? Their debt suddenly doubled overnight because their local currency was now worth far less. Businesses that looked profitable were suddenly bankrupt. Banks that seemed stable were suddenly insolvent. Confidence evaporated. Investors rushed to pull money out, and the crisis spread. Indonesia was hit next. Its currency, the rupiah, collapsed by more than 80%. Businesses closed. Food prices surged. Millions fell into poverty. Riots erupted in the streets. The crisis became political. Longtime President Suharto, who had ruled Indonesia for over 30 years, was forced to resign. A financial crisis had turned into a national upheaval. South Korea, one of Asia's strongest economies, was not spared. Major conglomerates had borrowed heavily in foreign currencies. When confidence dropped, foreign lenders refused to roll over short-term loans. South Korea ran out of dollars to pay its debts. The country was on the brink of default. In late 1997, South Korea turned to the International Monetary Fund for help. The IMF approved a massive bailout package worth over $50 billion. It was one of the largest rescue programs in history at the time. But IMF assistance came with strict conditions: higher interest rates, spending cuts, structural reforms. To many citizens, it felt like humiliation. People lined up to donate personal gold jewelry to help rebuild foreign reserves. An entire nation mobilized to survive. Malaysia chose a different path. Instead of accepting IMF conditions, it imposed capital controls. It restricted the movement of money out of the country. This was controversial. Many economists criticized the decision, but Malaysia stabilized faster than expected. The crisis divided economists for years. Should countries open markets fully and accept painful reforms, or should they protect themselves during panic? There is still debate today. Stock markets across Asia collapsed. In some countries, markets lost over 60% of their value.
Foreign investors fled, construction stopped, unemployment surged, middle-class families lost businesses, homes, and savings. What began as a currency problem became a full economic depression for parts of Asia. Millions were pushed below the poverty line. Growth that once seemed unstoppable had reversed violently. But here's what makes the Asian financial crisis so important. It wasn't just about bad investments, it was about leverage, it was about foreign debt, and it was about confidence. These countries had strong growth, but that growth was funded by short-term foreign capital. When confidence disappeared, so did the money. And when capital flows reverse quickly, economies break. There was also a deeper structural issue. Many Asian banks were closely connected to governments. Loans were often given based on relationships rather than risk assessment. Transparency was weak. Financial regulation was underdeveloped. When global investors finally looked closely, they saw vulnerabilities everywhere, and markets react brutally to vulnerability. By 1998, the crisis had even affected Russia and Brazil. Global markets felt the shock. The world realized something important. Financial contagion is real. When one country collapses in a highly connected financial system, others can follow. The Asian financial crisis reshaped global policy. Many Asian countries began building massive foreign currency reserves afterwards. They became more cautious about foreign debt. They strengthened banking regulations, and they learned a painful lesson about depending too heavily on short-term capital. Today, Asia is once again a center of global growth, but the memory of 1997 remains. Because crises don't begin with weakness, they begin with optimism, too much optimism. They begin when risk feels invisible, when borrowing feels safe, when growth feels guaranteed. But in financial systems, nothing is guaranteed. Currencies can fall, capital can flee, confidence can vanish. And when confidence disappears, numbers on paper stop mattering. The Asian financial crisis was not just a regional event, it was a warning. A reminder that in a globalized world, financial stability depends not only on growth, but on discipline. And history shows that whenever leverage rises and risk hides behind rapid growth, the system eventually corrects itself, often violently. And that is how one small currency collapse in Thailand triggered one of the most devastating financial crises of the modern era.